Okay, we're now for chapter 18, which is about international capital budgeting. This chapter is based on a very elementary account and finance chapter, capital budgeting. We just upgraded by incorporating the exchange rates. All right, so previously we learned the domestic capital budgeting. So we learned how to find the cash flows and identify the size and the timing of those cash flows. And also we need to find the proper discount rate. And that discount rate is associated with the riskiness of the cash flows. So basically for higher risky projects, the investors would require higher return. So that makes the firm to pay more dividends, to pay more interest to the investors. Okay, and that's more cost of capital for the company, and the company will use that cost of capital as discount rate for the cash flows. All right, and then based on the discount rate and the cash flows, we find an NPV, and then we compare the competing cash flows at the same point in time. And this is the formula to get NPV. So as you can see, we have operating cash flows occurring on the annual basis with discount by the cost of capital. And we also have a terminal value of the projects. It usually occurs when we end the projects, sell the machine for salvage value, and liquidate all the remaining inventory. That's how much terminal value is. And then today we're gonna spend some money upfront to establish the business. So we have a cash flow 0, and that is negative. All right, let's just get on to business. Here is a project, and this project cost us $1,000 upfront. In year 1, it gives me 125. In year 2, give me 250. Year 3, year 5, those are the cash flows. Okay, and now we have a cost of equity, which is 10%. Unlevered means this is a purely equity financed firm. There's no debt at all. So a 10% cost of equity basically is the cost of capital for the entire firm. All right, so we would reject the projects, okay, if the NPV is a negative, and we would accept the project if NPV is a positive. Okay, previously we learned this. We're gonna input negative 1,000 as cash flow 0, and 125 for cash flow 1 and all the other cash flows, and also put the interest equals to 10 and solve for NPV, that is a negative 56.50. All right, so right here, if I want to demonstrate the same old calculator technique, so you're gonna do apps and then finance, which is number 1, and then go down to NPV. All right, and you're gonna put a 10 for 10% and a negative 1,000 for cash flow 0. Okay, and then I put cash flow in the future, so that's 125, 250, 375, and 500. Okay, I think sorry. It's apps finance number 7, 10, negative 1,000. Okay, then the bracket 125, 250, 375, 500, and then hit enter. Okay, so negative 56.50. All right, so once again, this is the formula we use to get all the cash flows. In the international finance class, all these cash flows could be denominated in euros, pounds, or Japanese yen. All right, so the annual cash flows could be broken down into operating cash flows, and then you multiply by this 1 minus tax rate to get the after-tax part of the cash flow, and you also need to get the depreciation times the tax rate, and also the interest times the tax rate. So this was covered in the Finance 300 class. I'm not going to cover the details for this one again. So what I'm going to test you in the final exam, okay, is to get NPV under different currencies, and then you're going to convert that cash flows into a U.S. dollar denominated NPV. Okay, so we're gonna follow this procedure. We're gonna estimate the future cash flows in foreign currencies, and then we convert to home currency at the predicted exchange rate. And in particular, we use the purchasing power parity theory, international Fisher theory for the predictions. And then we calculate NPV based on the dollar figures, which are converted from the foreign currency. Okay, and here we have some assumptions here. The assumption is we have of course, this is a US company and everything has to be converted in dollar terms at the end of the day. And we have a foreign business in a European country, and let's say we receive euros for the future cash flows. And also, we have these assumptions, that is no incremental debt, no incremental depreciation, no more loans or no more restricted funds. So that basically tells us on the capital side, there's no change. And this company is still financed with the US capital, okay, with the US capital. And there's no change of structure of the US capital, and you are still paying the same interest and same dividend in percentage to US investors. So that means the cost of capital or the discount rate of the cash flows would still be the same. All right, so here are the cash flows in euros. So at year 0, we spend negative 600 euros, and in year 1, we receive 200 euros, year 2, 500, year 3, 300, okay? And our main task here is to convert all the future euros into future dollars. Well, here's the challenge. We are not sure about the exchange rate 1 year later, 2 years later, or 3 years later. Okay, we only know the exchange rate today is $1.25 per euro. Okay, is there a way to solve for it? Solve for the exchange rate in the future? Of course there is, and we have learned that in chapter 6, the parity chapter. And basically, the exchange rates a year later could be forecasted based on the exchange rate today and the inflation in the Eurozone and inflation in the United States. So basically, when you see this $1.25, it will be multiplied by 1 plus 6% or US inflation rate divided by 1 euro times 1 plus 3% euro rate. Okay, and then you'll be able to forecast the spot rate a year later and use the same procedure. You will develop the exchange rate 2 years later and the exchange rate 3 years later. Okay, so here, let me show you how to do it in Excel. Okay, this is supposed to be easy. Year 0, year 1, year 2, year 3, and you have negative 600, 200, 500, and 300. And these are all in euros. Okay, these are all in euros. Let me format sales and currency, make it, oh my goodness, euro. Where's euro? Okay, so those are euro terms. Well, this does not look very nice. So let me do this. Just format printer, copy the format here, and then get the format there. Okay, so this is the format I really want. Okay, so what we do is we need to know the exchange rates. So this is the euro cash flow, and we also need to know the exchange rate of euro. So today it is $1.25 per euro. So let me just put it there, $1.25. Okay. Okay. And how do I get the exchange rate a year later? It is going to be 1.25 times 1 plus the US interest rate, US inflation rate, which is 6%, okay, divided by 1 plus 3%, which is the euro inflation rate. Okay, so basically that's the multiplier we're gonna use to develop the exchange rate in the next year. And here I'm going to put a caret and put the year number from the top cell. So basically, the exchange rate 1 year later is the exchange rate in the previous year. Sorry, just do this. Just is the exchange rate in the previous year times 1 plus the 6% U.S. inflation divided by 1 plus 3% euro inflation, right? So that's the exchange rate in a year later. Make it smaller. Okay, and then I just drag it. You see the exchange rate 2 years later is based on the exchange rate in the first year times the same multiplier, which is 1 plus U.S. inflation divided by 1 plus euro inflation. Okay, and now we will find out the dollar cash flow. So basically, we're going to use the exchange rate multiplied by the amount of a euro cash flow. So that's going to be in dollar figure. Okay, and I just drag it. All right, so these are the dollar cash flow. And eventually, we will find NPV in dollars. All right, so the NPV right here is based on several things. The first thing is the discount rate. Okay, that discount rate is purely determined by U.S. finances or the U.S. cost of capital. All right, we need to find a number there, and then we're gonna plug it in the cash flows. All right, so in the context, it says the firm has a cost of capital of 15%. So basically, it says the business risk of this investment would lead to demand return of a 15%. Okay, so for such investment, risk is estimated first, and then investor require a 15% return. If investor require 15% return, the investor will get 15% return. The firm has to pay 15% return to attract investors. If they do not pay 15% return, then there's no money, there's no capital injected to this business. Okay, so let's say it's an NPV 15%. Then importantly, here we see the value 1 starting at value 1, not value 0. So it's all future cash flows in the NPV box. And for the future cash flow, you're gonna add it outside the NPV box, all right? So this is how much you get for the NPV. Nice and easy. And right here, here's teaches you how to get the exchange rate in the future based on the purchasing power parity. This is something we covered in chapter 6. And you're gonna convert all the euro figures to dollar figures, okay? And then you compute the NPV based on this converted dollar figures.